So come to this slide again. This advantage to the issuer of ADR, no change in the shareholding or voting pattern. So you can just add one more line that the voting rights are determined by terms of issue. So now there was an amendment. Voting rights are determined by terms of issue. So sometimes the voting rights are given to shareholder. In case of Infosys, I saw during the break time, the investor has voting rights. In some case, the voting right is given to that custodian. Okay. So actually, when I was doing some R&D on voting right, it's a very complicated voting right in case of ADR. Proxy. It depends on the terms of the issue. Sometimes the depository can vote. Sometimes the voting rights are transferred to management. Voting rights of ADR holders are transferred to management. So as I said, this is a bit complicated part, the voting right part. It's not very simple that I will say one share, one vote. One ADR is represented by two shares or two votes. So it's not that simple. Okay. So you can just simply write voting rights are determined by the terms of the issue. And it's a bit complicated. Now we'll come to next instrument, which is similar to ADR, but it is issued outside America. So it is called Global Depository Receipt, GDR. So companies which do not want to get themselves listed on American Stock Exchange because of high cost and compliance, then they can issue in European stock exchanges like London or Luxembourg, which are two popular stock exchanges where shares of other countries are listed. So GDR are like ADR, negotiable certificate with publicly traded equity of the issuer as underlying security. As issue of depository receipt would involve the issuer issuing agent to a foreign depository. Shares will be first issued to a custodian. Custodian will inform the depository, and then depository will issue depository receipt to the investors. So the depository in turn issues GDR to investor, evidencing the rights as shareholders. Some companies give all the rights of shareholders to GDR holders, same dividend, same voting right. Depository receipts are denominated in foreign currency. One of the objective of issuing depository receipt is to raise funds in foreign currency, so that that money can be used for your foreign operations, foreign joint ventures, foreign associates, and also purchasing capital asset, raw material, inventory or components, and are listed in international exchanges. The two popular exchanges where GDRs are listed are London Stock Exchange and Luxembourg Stock Exchange, which is also in Europe. GDR enables investors to trade a dollar denominated instrument on an international stock exchange and yet have rights in foreign shares. Same like ADR, they can enjoy the benefit of investing in a foreign company without having to actually invest in their currency. There means the local currency of the country from where the shares are issued. So suppose you are in USA, you can invest in dollar. You are in London, you can invest in pound. You are in Luxembourg, euro. Okay, enjoy the benefit, and you don't have to convert your currency also, like ADR. In fact, if they ask you what are the advantages of GDR, you can write advantages of ADR. The principal purpose of GDR is to provide international investors with local settlement. So they will buy in their country, sell in their country. They don't have to come to India. The issuer issuing the share has to pay dividend to the depository in the domestic currency. So how do you do the calculation of dividend? Suppose 1 lakh shares are issued as depository. Face value is 10 rupees. Dividend rate is 40%. So first they do the calculation in rupees, and then they convert into foreign currency at the exchange rate, and this much amount is paid to the investors. So who will absorb the exchange risk here? Investor. Company will have to pay fixed amount only. Suppose this comes to let us say 4 lakh rupees. So from their pocket 4 lakh will only be transferred. Suppose the exchange rate is 70. So 4 lakh will have to be converted at 70. Investor will get 4 lakh divided by 70. If exchange rate is 80, 4 lakh divided by 80. So this amount after conversion is handed over to the investor, but company will have to only pay 4 lakh. These are also subject to DDT. These are also subject to DDT, dividend distribution tax, because this is also dividend. It is treated like any other dividend. Depository has to convert the domestic currency into dollar for onward payment to receipt holder. GDR bear no risk of capital repayment because it is equity. It is equity, hence there is no repayment obligation. Had it been bond, then there would be repayment obligation. GDR is also issued with warrants attached to them. Now what is a warrant? Tell me. Warrant is an instrument which entitles the holder to purchase share at a later date. Warrant is an instrument which entitles the holder to purchase the share at a future date. So right now you don't have to pay the full price of the share. You can pay just a small amount, get the warrant, and then future date you pay the remaining amount and convert into shares. Warrants holders don't have voting right, of course. And when it is in the form of a warrant, it does not have voting right. It does not have dividend right also. So warrant give the investor an option to get it converted into equity share at a future date. Warrant help the issuer to charge some premium on the GDR sold, because we tell the investor, see, I am also giving you an option to purchase share at a later date. So if their share price goes up, you will make profit out of it. Is it right? So therefore they charge premium. It also helps to increase the demand of the GDR issue. It is like a added incentive to the investor. He not only gets the GDR, he also gets the warrant. The other advantage to the issuer is that it will not have to pay dividend on the warrant. Dividend is not paid on warrant till the conversion option is exercised. But there is a disadvantage. You do not get the full value of the warrant at the time of issue. You will get the amount only on conversion of warrant into shares. And in case the conversion option is not exercised, the expected proceeds will not be realized. So your cash flow calculations will be difficult, will go haywire if the investor do not opt for conversion of warrant into shares. Because many times we plan our cash flows thinking that these GDR holders will convert their warrant into shares. But if they don't convert, my cash planning will go for a toss. One more paragraph I have added from my side is this paragraph. Differences between ADR and GDR. Differences between ADR and GDR. So these are some important differences. They can convert it into a MCQ, fill in the blanks, true or false, case study, that why you should issue ADR or why you should issue GDR. GDR is quoted on stock exchanges other than USA. ADR is quoted in USA. GDR disclosure requirements are less stringent. That is one reason why company issues GDR. In USA, disclosure requirements are more stringent. Correct? Because US laws are very strict. And only institutional investors can participate in the offer. Means only the institutional investor, mutual fund, insurance companies, or hedge funds, pension funds, and such other institutional investor. ADR, everybody is welcome. Even the retail investor can participate. You means if American investor, Donald Trump can also purchase the share. Okay. US institutional investor can also participate. Now, where you have more trading in GDR or ADR? Because in ADR you have retail investors also participating, whereas in GDR you have limited institutional investors, so stock may not be valued at fair value because limited number of investors are there. But here we have more number of investors, more people are participating in buying and selling. Valuation of the stock on account of participation of retail investor will give a better valuation. Why companies should go for GDR as an option? Low cost of compliance as compared to ADR. Listing fees is less. You don't have to comply with strict US regulation. Legal fees will be lower. Accounting and audit fees will be lower. Whereas in case of USA, one disadvantage we have seen, high cost of compliance. GDR is traded in more than one currency like pound, euro, yen. Depending upon where you are issuing, ADR will be traded in US dollar only. Yes, so there is a these are the disadvantages. That is why you have to compare the advantages and disadvantages, and as a management consultant you have to see which is more beneficial for you. Still some companies goes for ADR because it brings more visibility, it brings more reputation, goodwill, and you are exposed to US investors and US consumers. Brand valuation is there. Branding, you will only tell your client that we are a foreign listed company, plus you raise money also. Once you have raised money, you are happy. And sometimes some companies think it is better we have few sophisticated, educated investors rather than a large number of people holding our shares. If you go to the AGM of Mukesh Ambani company Reliance Industries, suppose sometimes you get a chance to go, one investor comes there every year. He is holding some few shares only, 100 shares, let us. But he is a shareholder, so he gets a chance to speak. So he says, "Sir, I want to recite a poem." Recite a poem. So he comes with a long poem, and he takes almost 10 minutes of the AGM to just read the poem. One shareholder comes, he just keeps on praising the company for 5-10 minutes. He says, "I purchased in 1980s when your father was there. My wealth has grown. You are doing good work," etc. One shareholder I have personally seen, he will read the whole balance sheet, because they have a lot of time. He is a retired person, 65, 68-year-old. And he says, on page number 32, there is a spelling error. On page number 45, the total is not telling. Yes. And then this Mukesh, he just keeps sitting and waits for him to complete. And they just have to bear such investors. The foreign company receiving deposit receipt in India. How is it possible? Foreign company, when they issue their shares in India, it is called IDR. So like Standard Chartered Bank have issued their shares through depository in India that is available for trading now on the stock exchange. So maybe one or two companies have issued their shares in Indian market, that is called IDR. But very few companies, because first the laws are very strict in India and they do not think that Indians have so much money to invest in their shares, or they don't need funds from India. Unwritten rule, they don't like India also many times as a source of raising money. Okay, because Indian politicians, you just can't predict them. Can we? They do anything. They can build statues everywhere over a period of time. Now they are planning to build a statue of Sri Ram, which will be twice the size of Vallabh Patel statue. They are also trying. Twice the size of that Sardar Patel statue, Sri Ram statue. So that even if you go to Jupiter, you can see from there that statue. That will be the visibility. Okay, that was just a joke, the Jupiter part. Yes. You will see soon. In your lifetime only. Don't worry. Now next part is derivative. What is derivative? I'll go through quickly because this is a full chapter in your SFM. Derivatives are financial instruments like future, option, swaps, which derive their value from other instrument, other assets, which are called technically underlying. Okay. So that other instrument from which they derive their value is called underlying. The two most commonly used derivatives are futures and options, because they are traded on the exchange and there is a huge volume of trading in futures and option. F&O, they are popularly called as F&O, and they are traded on the exchanges. So stock exchange has two segments now, cash segment and derivative segment. In cash segment, actual shares and debentures are traded. In derivative segment, derivatives like future, option, swaps are traded. Okay. Derivative will derive its value from the other asset. On its own, it will not have value. Its value is linked to value of something else. As the value of that other instrument will change, the value of the derivative will also change. Therefore, the name derivative, because its value is derived from the value of the underlying asset. And what can be that underlying asset? Theoretically speaking, anything whose value is likely to change, you can create a derivative. In fact, there are derivatives on weather also, which is traded on the exchange. Derivative on weather, that it will be rainy season, temperature will be so much, derivative. It's like you just have to gamble on anything. Okay. So in India, the three popular underlying on which you have derivatives are shares or index, that is security, then commodities, very popular, and again very popular underlying is currency futures and currency option, and the volume is also very high. The volume of the derivative market is more than share market on a daily basis. Do you know that? That is a statistics. Now the derivative market has more volume than stock market because it requires very less investment and gives you a very high amount of profit. It value varies with the value of the underlying asset. In case of derivative, you have to deal in lot sizes or contract size. Share market, you can buy one share also, but in derivative market there will be always a lot size. Like for example, Nifty future contract has a lot size of 50 units. There is a mini Nifty also. How many units are in mini Nifty? 20 units. What about the lot sizes for shares? It varies from shares to shares. If the price is high, lot size will be small. If the price is low, lot size will be higher. Okay. And the lot sizes keep changing also. Originally Nifty lot size was 200 units originally when it was launched, Nifty future, some 15-16 years ago for the first time, and then they made it 100 units and now it is 50 units, and again there is a 20 unit also. So you can, for students, 20 unit. Okay, small investment, high profit. Why F&O section is very popular? Because you don't have to invest the full value of the underlying. Suppose you want to invest in gold. You think that gold price will rise after 3 months. You buy 1 kg gold, it will cost you say 30 lakh rupees. Is it right? So you have to invest 30 lakh rupees, and if gold price rises by 2 lakh, you'll earn 2 lakh profit in 3 months. Why should you do that? You can instead of that buy gold future. Gold future, and you have to pay margin money of say 10%, 3 lakh rupees. When you take a position on 1 kg gold by paying a margin money of 3 lakh, if the price increases by 2 lakh, here also you'll make a profit of 2 lakh. But see the difference. If you buy physical gold, you have to invest 30 lakh to make a profit of 2 lakh. If you invest in gold future, you invest 3 lakh and you make a profit of 2 lakh. So here your rate of return is 67% in future market. There your rate of return is 7 or 8%. What is better? Future is better. Okay. You can take a larger exposure. So in here with 30 lakh rupees, you can take a 10 time exposure in the future market. Okay. So therefore, generally in future market, who are the players? Usually people like you, the high net worth individual. Yes or no? No. I always lose in derivative market, so I have stopped now. I don't know, my luck is bad. Because any bet I take in future, that share always goes down. Next time you do opposite. Means what? Short. Then it will rise. Okay, I will listen to your advice. Tomorrow I will do short selling. Suggest me some. Okay, I'll give you 10% profit. In case of loss, you give me 10%. No liability on the part of student. Okay, suggest me some stock where I should go short tomorrow. You don't know. Okay, homework. Island FS. Okay. Now tell me how to make profit in the future and option market. It depends on your expectation. Okay. According to your expectation, you take the position. First, what is a future? Future is a contract to buy or sell the underlying security at a specified price on a specified date. And in case if you buy the future and if the price rises, you will make profit. If you sell the future and if the price falls, you will make the profit. Do you know that? If you buy the future, it means you have an obligation to buy as well as a right to buy at the predetermined price. If you sell future, you have a right and obligation to sell at a specified price in the future. The contract will expire on a pre-specified expiry date. That is one, you can say, advantage or disadvantage, whatever, that the future and option comes with an expiry date. On that day, that future will expire and whatever is your gain or loss will be calculated and handed over to you. Okay. In India, future and options expire on the last Thursday of the month. And if it is a, say, holiday for some reason, then previous working day. Last Thursday would be normally around 28, 29, 30, 31st or 25, 26. And at a time, there are 3 months available for you for trading purpose. Either the current month or next month or after that month. And once 1 month is closed, a new month opens, a new series opens. So right now the maximum maturity of a future contract in the Indian market could be only 3 months. You can't enter into a 5-year future contract right now. That is not available only. Because that option will show you 1 month, 2 months, 3 months. You have to take one of them. Upon expiry, the contract must be settled by delivering the underlying asset or cash. So at present in India, future contracts are settled by cash only. The winner gets the amount in his bank account. The loser pays the amount from his bank account. You can also roll over the contract to the next month. If you do not wish to hold it till expiry, you can close it midway also. Why futures are so popular? You don't have to wait till maturity. You can reverse your position. If you have bought future and then if you don't want to hold it, you can sell it. If you have sold it, you can buy. Okay, or you can again purchase a new lot in the next series. In future contract, the buyer and the seller have an unlimited loss or profit potential. True or false? Both the parties are exposed to unlimited risk, unlimited return. The future is a dangerous game. You should enter into this market only if you have the ability to absorb the loss. Okay. Otherwise, you will suffer a heavy loss and you may have a heart attack also. So therefore, take risk, but after knowing it. Now I am not going to take problems on future. Please read your SFM for future problems. Right there, refer SFM. Otherwise, one full chapter which takes 3 to 4 days, I have to discuss. Same thing for option also. Right there, refer SFM. If you are appearing for both the groups, it is easier for you because you will study SFM also. But if you have passed group 1, then you have to read SFM options also. What they will ask, we can't say, but option, anything can be asked as a part of your syllabus. Okay. So I am giving you enough advice that you must read the SFM book also. Don't sell SFM book even if you have passed group 1. Keep it. It will be required in this subject. What is the benefit of entering into an option contract compared to future contract? It is a right but not the obligation. To buy or not to buy, or sell or not to sell. Buy or not to buy is called call option. Sell or not to sell is called put option. So an option is a contract which gives the holder of the option the right but not the obligation to buy or not to buy, or sell or not to sell a specified quantity of a specified underlying at a specified price on a specified date. The specified price is called exercise price. The specified date is called exercise date or expiry date. Okay. Being an option holder, you have an advantage, you have a right but not the obligation to do so. So you will exercise the option only if it is beneficial to you. If it is not beneficial to you, you will let the option lapse. But seller of the option has a disadvantage. He will be obliged to deliver the underlying asset or purchase the underlying asset if the option holder wants to exercise his right. And as you know, option holder will exercise his right only if he is going to make the profit. Means the option writer is going to suffer the loss. Option seller is called option writer. Option seller is called option writer. And option buyer is called option holder. You should know both the terms. Option buyer is called option holder. Then you have to tell me what are the two types of option. All options will be either or, call or put. Then what is a call option? Call option is a right but not the obligation to purchase the underlying asset at the specified price by paying a premium. See, I am just trying to revise because I am sure you have done it in SFM. Call option is a right but not the obligation to buy at the specified price. Means you will enter into a call option contract as a holder if you are expecting that the price will go up. Is it right? But if you think that the price will go down, you will not buy a call option. On expiry date, if the price actually goes up, you will make the profit. But if the price goes down, you will let the option lapse because you have a right but not the obligation to exercise the option. What is the loss that you will suffer? Premium. The maximum loss you will suffer is the premium that you have to pay because that is the cost of buying a call option. That is the cost of getting this advantage. Okay. So call option or put option premium, you can say, are like insurance cover to the holder. He will not suffer the loss, but he may gain. Okay. And then the other party is called writer of the call option. If the option holder wants to buy, the call option writer is obliged to sell at the exercise price. Exercise price is also called strike price, specified price. Okay. Now let us discuss put option. Put option is a right but not the obligation to sell the underlying asset at a specified price by paying a premium. So put option is a right to sell but not the obligation to sell. So please guess, when will you pay premium to get a put option? When you are expecting that the price will fall. The price falls, you will make profit. But if the price rises, your put will lapse, you will lose the premium. What is the obligation of the writer of a put option? Holder has a right to sell, so writer has an obligation to buy. Writer has an obligation to buy at the strike price. Okay. In any option contract, the right to exercise the option is vested with the buyer of the option. Of course, because if both the parties are given the right but not the obligation, Option will never be exercised only. If holder wants to exercise, writer will refuse. If writer wants to exercise, holder will refuse. So therefore this right is only to the holder of the option. The writer has only the obligation. So you will say that writer is at a tremendous disadvantageous position. But then we compensate him by paying a premium. And as you have learnt in SFM, higher the chance of the option getting exercised, higher will be the premium. Is it right? So buyer of an option can make unlimited profit or very high amount of profit, and his risk is only limited to the extent of premium paid. Limited downside risk means only what maximum he would lose, the premium. But again, please remember, it is not a small amount because you have to buy in lots in India. And sometimes even once one lot may cost you some thousand of rupees. At least 1 month stipend you will have to take a risk to buy a call or a put option. Okay, try next month. Huh? 1 day stipend. Why? No, because you have to buy in lots. You have enough money, I know, you don't reveal it. The fact that you are doing CA course means you must be a rich person, because you know that it might take so many years to become CA, so I can afford to remain unemployed for many more years. Yes or no? That is why you are a rich person. Okay, what about the seller? Seller has only limited profit potential. What he will get? Only premium. But his loss potential is very high. So a quick look at this option flow chart. There are two types of option: call option, put option. There is a call buyer, there is a call seller. Call buyer has a right to buy. Call writer has an obligation to sell. Call buyer pays premium. Call writer receives premium. Put option, there are two parties, buyer and seller. Buyer has a right to sell. Seller has an obligation to buy. Buyer pays premium to the writer of the option. And then I have only given you a small summary from my SFM book. What will you do in case of call and put option? If your expected market price is greater than strike price, or if you are expecting that market will go up, what will you do? Either you buy a call, because if the market goes up, you will make profit on call option if you have bought it, or you make a small correction here, sell a put. Why sell a put? If the market goes up, put will lapse. Put will lapse. What is your profit? The premium that you will receive will become your profit, because option would lapse, but you have received premium for writing a put option. So when you expect the market to go up, rule of the game, either you buy a call or write a put. If you buy a call, you make huge amount of profit. As the share price will rise, for every 1 rupee rise, you will make 1 rupee extra profit. But if you write a put option, the option will lapse, you will make premium as a profit. If the market is expected to fall, sell call. Same reason. If market is going to go down, call will lapse and your premium received will become the income. Premium received will become the income, or you buy a put. The difference in these two strategies, as you know, if you become a writer, loss potential is very high, profit potential is limited. If you hold an option, profit potential is very high, loss potential is limited. Depending upon your risk taking abilities, you may either become a holder or a writer. And what if there is no expectation about change in the share prices? don't enter into derivative market. Derivative market is meaningful only if there are volatility, price changes. Right. One more paragraph from my side. Difference between future and options. Future involves right as well as obligation. Okay. Whereas option involve only right but not the obligation. Underline the future. In future, obligation must be fulfilled by both the parties. Obligation must be fulfilled by the buyer also, the seller also. Whereas in case of option, the holder has a right to exercise or not to exercise his option. Obligation must be fulfilled only by the writer of the option. Right. Only writer has to fulfill the obligation. Only writer has to fulfill the obligation. Why people enter into future transaction? Because there is no premium payable. Both parties are exposed to the risk. Buyer is also taking risk, seller is also taking risk. So we don't pay the premium. However, in order to ensure that the contract will be honored by the parties, margin is required to be deposited with the exchange. What is required? Margin. Initial margin, mark to market margin. Okay. So that you will honor the contract. Margin calculation is covered in our SFM syllabus. So again, please refer SFM chapter for that margin calculation. In case of option, you don't have to pay the margin. The holder does not have to pay the margin because he does not have a risk. The writer has to pay the margin and the holder has to pay the premium because he gets the right to buy but not the obligation to buy. You can just write here, writer has to pay margin. Because who is exposed to the unlimited risk? Writer. If there is a huge loss, the writer may run away. So exchange takes margin from writer of an option. Point number 3, profit or loss potential. In future, both parties are exposed to unlimited profit or loss potential. Both parties. They can earn any amount of profit, they can lose any amount of loss. They can have any amount of loss. In option, as we discussed, holder has unlimited profit potential. Writer has unlimited loss potential. Holder has limited loss potential. Writer has limited profit potential. So these are the future and options. Then advantages of option. Why many investors go for option strategy? There are people who don't want to lose a huge amount of money, so they think it is better I take a option only. So there is a limited risk for many option strategy. What is the maximum loss that you can suffer? Premium. And that you know at the beginning only. That in case if I enter into this option and if I have to pay 10,000 rupees as premium, in the worst case scenario, I would lose 10,000 rupees. So you know exactly how much can be your maximum loss here. Mentally you know that this is what I am taking the risk. And plus there are a lot of strategies which are available in option. In SFM we have seen the strategies. The moment any wording is used in this module, it means you have to refer SFM for some problem. Butterfly spread, bull spread, bear spread, straddle, strangle, strip, strap. 6 strategies you have to learn. I will write, you refer the SFM book. Straddle, strangle, strip, strap, Bull and bear spread, butterfly spread. Now you will ask, will they ask question on strategies in capital market? They can. They can. Okay. So my duty is to inform you that whatever are discussed in this module, and if there are some numerical questions, they may create a problem on that, which may require some basic knowledge of SFM also, but they will ask basic questions. With a forward and future contract, the investor is committed to a future transaction. With an option, he enjoys the right to go ahead, but he can walk away from the deal if he so desires. So in option, there is a right but not the obligation. That is advantage. Option have certain favorable characteristics. Again, they are saying loss potential is limited, profit potential is very high, but that is only to one party, holder. What are the disadvantages of option? If the volatility is high, option premium can be very expensive, because premium depends on the possibility that the option will get exercised. Higher the possibility that the option will get exercised, higher will be the premium. Is it right? So in Black and Scholes model, if the volatility is high, the premium is also high, because chances that it will get exercised is high. There are more complex factors affecting premium prices for option. Premium for option is affected by many variables, like for example, current market price of share, exercise price, interest rate, time to expiry, volatility, dividend. How many factors I have told you? 6. Once again, exercise price, market price, interest rate, time to expiry, volatility, dividend. These are 6 factors I have told you. There may be other market related factors also. So as those variables will change, the value of the option will also keep changing. Volatility and time are often more important than the price movement. So these are the disadvantages. Now next part of this wonderful chapter is, now we are entering into a new territory. The topic is aspects of primary market, that is new issue market. So what we have covered, the instruments. The last few discussion was on different types of instruments used in capital market. Okay. And now we will see the different aspects of primary market. So in primary market, suppose the company wants to raise money. We have discussed that primary market is a place where the company raises the funds. So how do they raise the funds? They raise the funds by public issue, right issue, bonus also we'll discuss, although in bonus they don't receive the funds, and private placement. Okay, and because this is a special subject, you have to know detailed meaning of these terms, as well as if any regulation is there, some knowledge of that regulation is also required. Otherwise I can just simply say in 2 minutes, public issue means shares issued to general public, right issue means shares issued to existing shareholder, bonus shares are issued free of cost, private placement is shares issued to selected group of investor. But no, you have to read little more, benefits, disadvantages, pricing, okay, any related regulations in that field. So while right issue by a listed company and public issue involves a detailed procedure, bonus issue and private placements are relatively simpler. Most complicated is public issue, less complicated is right issue. Again, these two are even less complicated because you don't have to raise funds from first public in case of bonus issue. Private placement, you have to deal with few investors only. So again, it depends on management. How do they want to raise funds? Risk involved, dilution, okay, and regulations, cost, all these factors are considered, and then they decide which method they are going to apply. So classification of issues is now public issue. Means you are raising funds from public in general. All candidates in the market, all uh, shareholders, all people, general public who are eligible to apply can apply. You can also apply. Now you are also eligible. IPO, initial public offer, and one more thing is further public offer, FPO. That means a listed company wants to again make a public issue. Initial public offer is when an unlisted company for the first time, it was unlisted, now it wants to make a public issue, IPO. It has got listed after 10 years, it wants more money from the shareholders. So it can either go for follow on public offer or right issue, or sometimes combo, that is called composite offer, where public and right issue both are launched together. And then, as you know, in your inter syllabus also you have studied right issue, shares offered to existing shareholders but at a price, not free. Composite issue means simultaneously they go with public and right issue. Bonus issue, without any cost, shareholders get the shares. Private placement to selected investors. Private placement also will discuss under three headings depending upon the regulation, depending upon SEBI regulation. So private placement is three types: preferential issue, discussion later; QIP, qualified institutional placement, means only issued to selected qualified institutional investor, or similar version is IPP, institutional placement program. What they should ask to you in the exam, suppose they will say company wants to raise funds, which of the following method as a consultant you will suggest? Public issue, right issue, private placement. Under private placement, which method you should suggest, etc. So that will help in testing the intelligence of a student, understanding. Okay, so we'll go through one by one. Again, the same thing is appearing in the form of a chart in your book. There is a public issue, right issue, bonus issue, private placement. Public issue is of two types: initial public offer, further public offer. Private placement is of three types: preferential issue, QIP, IPP. Okay, now we'll see public issue. When you have to raise huge amount of money, then what is the better option? Public issue, because then crores of investors can participate and subscribe to the shares of the company. Okay, so that is public issue. Even FPO is a form of public issue. IPO is by an unlisted company, FPO is by a listed company. So what is an IPO? When an issue or offer of shares or convertible securities, when an issue of share or offer of share or convertible security, it is applicable not only for share, it is also applicable for any other convertible security, is made to new investor for becoming part of shareholders family of the issuer, it is called a public issue. Public issue can be IPO or FPO, follow on public offer. Then you want to know what is an IPO. What is an IPO? Now this can be a question in the exam. Differentiate between IPO and FPO. Differentiate between IPO and FPO. So you will say, when an unlisted company makes either a fresh issue of share or convertible security, or offer its existing shares or convertible security for sale, or both, for the first time to the public. So when an unlisted offers its share to the shareholder for the first time, to the public for the first time, then it is called IPO. It may be a fresh issue of share, or existing shares may be sold to public, like government does this. Government entities, sometimes government wants to raise money. What they do, they sell their shares to the public and get the company listed on the stock exchange. Even that is called IPO. Disinvestment come IPO. If it is an unlisted public sector company. If it is a listed public sector company, then it can be called as a FPO. Okay. It is one of the methods of raising funds by the government when they dilute their stake and raise funds from the public. If it is an unlisted company, it is IPO. But generally, when we say IPO, it means a private company wants to raise money from the public at large. And once the IPO is done, the shares are listed on the stock exchange for trading. Okay. So this is what we discussed in one earlier topic, primary market. And after that, it is traded on the secondary market, that is stock exchange. What is FPO? When an already listed company makes either a fresh issue of share or convertible debenture to public, or offer for sale. Offer for sale is of existing shares. Offer for sale is for existing shares. Like in case government wants to dilute its stake in the company. Government wants to dilute its stake in a public company, PSU. Then they sell their shares to public in general and they give it a name, follow-on public offer. It is called FPO. Now the time to write some lines. You want to write? Then write. IPO versus FPO. IPO versus FPO. 3 columns. Basis for comparison, IPO, FPO. Basis of comparison is first meaning. First write down IPO refers to, just write IPO refers to an offer of securities. IPO refers to an offer of securities made to the public for subscription. Made to the public for subscription by the unlisted company. This unlisted word you add. Made for subscription to the public by the unlisted company. So next year, suppose we issue, AS Foundation issues shares to public, it will be called IPO, only for example. Why we should disclose so many things to public at large? Yes or no? I can dilute also. Dilution is not an issue, but then you have to issue annual report which will show P&L account. FPO means an offer of security for subscription to public by a publicly traded company, or you can write listed company, by a listed company. That is one major difference. Second, what is it? Second point is, what is it? IPO is a first public issue. FPO is second or third public issue. Second or subsequent public issue. Second or subsequent public issue. Okay. Third is write down issuer. IPO unlisted company. FPO listed company. Fourth, objective. Objective is raising capital through public investment. Actually, objective is same, but you can write raising capital through public investment. Raising capital through public investment. And FPO, subsequent public investment. Okay. What about the risk? Risk is high because you don't know how many subscription will be there. For the first time issuer, the risk of raising funds may be high, but once you are an existing company, you have a confidence. You know that there are investors who are going to subscribe. When if you have underwriters, but again you have to pay huge commission to them, because underwriters knows that this company's IPO may not be very successful, so they may go for a higher percentage of commission. But yes, the risk is now to a large extent reduced because of underwriting. So last point is just for understanding. Now in the exam they can give you some MCQ. They will say which of the following is true about FPO. Then these 3-4 points will be given and you have to identify which is true or which is false. Okay. So now next is right issue. Paragraph B, quickly, because you are well versed with right issue. There was some chapter also in the intermediate syllabus. Right issue means issue of share or convertible securities to existing shareholders on a particular date fixed by the issuer called the record date, and it is called right issue. The purpose of right issue is to maintain the proportionate shareholding of every investor. Is it right? Because every investor will be given proportionate share. So if you exercise your right, you will hold the same percentage of share which you are holding before the right issue. But of course, if you don't purchase the right shares, your proportion will fall. Okay. Why do companies go for right issue? First benefit is that the power of control remains with the existing shareholder. We will assume that they will exercise their right. Then point number 2, it prevents loss to existing shareholder on account of dilution in the value of their shareholding. If existing shareholders exercise their rights, then there will be no dilution in their shareholding. That is the reason they go for right issue. And the third reason why Indian companies go for right issue expenses are relatively less. Why it is less? Because you don't have to do elaborate public issue expenditure. Here you know your shareholders, you have their email address and physical address. So normally what they do, they send you the application on your email or physical copy, and you just have to fill that form, make the payment, and you'll get the allotment. So the cost is very less. Coming out with a detailed public issue is a very expensive exercise. Nowadays it will cost you something like 8 to 15% of the total amount that you raise, because a lot of marketing is done on TV, radio, newspaper, magazines, behind auto and buses also. the chance of success of right issue is more than the public issue. Logistically, it is easier to handle also because you have to deal with a limited set of your own investors. Now we will continue tomorrow.